Hello, it's News World for us here. Canada is currently grappling with a complex economic scenario, with the unemployment rate surging to a near 8-year high at 6.8%, as reported in November. This figure represents a significant increase from earlier in the year and is the highest rate observed since January 2017, barring the pandemic months of 2020 and 2021. This spike in unemployment comes despite a reported addition of 50,500 jobs in November, highlighting a disconnect between job creation and job market needs. The labor force participation has surged, with 137,800 more individuals seeking employment, more than double the number of jobs created, indicating a robust influx of job seekers into the market. This rise is largely attributed to the youth demographic, where unemployment has alarmingly climbed to 13.9%. These figures come from Statistics Canada and paint a troubling picture of the current job market dynamics. Wage growth is experiencing a deceleration, complicating the economic landscape further. The average hourly wage growth for permanent employees has slowed to an annual rate of 3.9%, down from 4.9% in October, marking the slowest pace since mid-2023. This slowdown in wage increases occurs amidst an inflationary environment, adding strain to the financial well-being of Canadians. In response to these economic challenges, the Bank of Canada has already implemented a significant interest rate cut of 125 basis points since June, bringing the key rate down to 3.75%. This includes a substantial half-point cut in October. The market anticipates further cuts, with expectations leaning heavily towards another 50 basis point reduction, driven by the latest employment data and the ongoing economic sluggishness. The Canadian dollar has weakened in response to these developments, depreciating by 0.48% to 1.4090 against the US dollar, equating to 70.97 US cents. This decline in the currency value correlates with a significant drop in the yields of 2-year government bonds, which fell by 12.8 basis points to 3.026%, reflecting rising investor caution. Looking ahead, the outlook remains cautious. Analysts like Andrew Grantham from CIBC and Michael Davenport from Oxford Economics Canada suggest that the Bank of Canada may proceed with further rate cuts in an effort to stimulate the economy. The consensus among experts points to a need for additional monetary easing to support an economy that is not only struggling to keep pace with job market demands, but also to achieve potential GDP growth, which has remained tepid with only a 1% annualized growth rate reported in the third quarter. This nuanced economic landscape requires careful navigation from policymakers as they balance the need to stimulate growth with the imperative to manage inflation and maintain financial stability. The situation underscores the challenges facing Canada as it seeks to recover from a series of economic setbacks and move towards a more robust and resilient economic framework. If you found this analysis insightful, don't forget to subscribe to our channel, News World for us, for more updates and comprehensive news coverage.